Hey guys, welcome back to the Everyday Money Guy. I put out a video a couple weeks ago about the things that I did with money when I was younger and the things that I wish that I would have done. And one of those things that I talked about was purchasing a multifamily building for 3.5% down to live in and rent the other side. And the cool part about that video is I had a real viewer reach out to me in real life saying that he was inspired by that and that he would like, some more information on buying a multifamily home for 3.5% down and living in one side, renting the other, and being able to essentially live for free. So we're going to talk about that today. But if this is your first time to the channel, go ahead and hit that subscribe button to grow your wealth, increase your success, and put you on the road to financial freedom. Also, smash the like button for me. That helps this video and this channel in the YouTube algorithm. So if you want to move out of your mom and dad's place or wherever you're at, you don't have a lot of money for a down payment, and you also really don't want to pay rent or pay a mortgage, there is a way around that by using FHA low down payment financing to purchase multifamily buildings, live in one unit and rent out the rest, and hopefully cover your mortgage and maybe even your utilities. This is one of the many things that I wish that I would have done when I was younger. Instead of purchasing a single family home, I had considered it, but then I just didn't do it. I purchased a single family home instead of a multifamily building, and I think that put me behind a little bit financially from where I could have been had I have done that. So we're going to talk about that today, what the requirements are, what that kind of entails as far as from your end, from being a landlord. So I'm going to take you through the process and what this would look like. This will be a little bit more difficult than purchasing a single family home, but I do believe that you will be far ahead financially if you consider this. The big deal is that you can use FHA 3.5% down financing to purchase a multifamily building up to 4 units. So obviously you can live in one, and if you have 2, 3, or 4 units, you may be able to cover the entire mortgage or at least some of the costs. Let's go over what the FHA requires for you to get that 3.5% down. You are going to need a FICO score of at least 580 to get 3.5% down. But if you don't have a FICO score of 580, anywhere from 500 to 579, you can put 10% down and still be able to qualify for an FHA mortgage. You are going to have to pay MIP, which is mortgage insurance, because it is a less than 20% down loan. This is very similar to PMI if you're just taking a conventional mortgage, and it insures the loan from default. Your debt to income must be less than 43%. When you add up all of your debts, compare that to your income, your total debt load cannot be more than 43% of your gross income. This must be your primary residence. FHA is in the business of making homeowners, essentially. So they want you to live in this residence. You have to be there for at least 1 year. This is a pretty universal thing with getting almost any loan, is that you have to be able to prove that you are employed and have steady income, and that you will continue to be that way in the future. So while all this sounds great, the FHA loan sounds great, you can get this with really marginal credit and not a whole lot of down payment, and it seems like a pretty easy loan to get. 43% debt to income is pretty high, so they'll go out on a limb for you here. But there are a few downsides. For one is the mortgage insurance that you have to pay monthly. That is a necessary evil, because without that, these type of loans would not be made. If you are taking the very low 3.5% down payment loan, that amount cannot be removed if your debt to income or your loan to value gets to be 80% or less. That is on there for the life of the loan. Actually, with the ones that are 10% down, you can have that removed after a certain time period. In addition, there is an upfront mortgage insurance that you will have to pay at closing that amounts to 1.75% of the entire loan. Now, this cost can be paid at closing, or it can be rolled into the loan. Again, it's just an upfront cost that you have to pay in order to get these loans. And that does stay consistent through all the loan amounts. If you go on FHA's website, it has different amounts of your monthly mortgage insurance that you'll have to pay depending on the size of the loan and the amount of down payment. And we're going to get into that next. In this example, we're going to be talking about a loan that is greater than or equal to $625,000 and a loan to value of greater than 95%. In that case, you are going to have to pay 0.85% annually of the amount financed, and that cannot be ever taken away from that loan unless you refinance it into another loan. Every year you're going to have to pay 0.85% of the loan amount broken up into 12 monthly installments that will be tacked on with your principal and interest and taxes and insurance if you escrow those all in one bill. All right, so let's get into an example and kind of get down and dirty in the numbers. Let's say that you find a duplex that has a purchase price of $200,000. Your down payment for that at 3.5% is going to be $7,000, and your loan would be $193,000. Your upfront mortgage insurance, which would be 1.75% of the loan amount, would be $3,377.50. So your total amount financed would be $196,377.50. If we just assume a conventional fixed rate mortgage, 30 years at 3%, your principal and interest will be $827.94. I just estimated taxes and insurance, and I estimated those at $800 for your insurance, 1.1% of the loan amount for taxes, which is the nationwide average. Altogether, that wraps up to be $1,077.94 a month. However, we have to add on your mortgage insurance, and again, that's going to be 0.85% of the loan amount, which for this would end up being $1,669.21 per year, or $139.10 a month, which makes the total $1,217.04, including your principal, interest, taxes, insurance, and mortgage insurance. So now you have to look at the property that you found and figure out what units would rent for. If you can cover that whole amount, if you can rent that unit for $1,200 or $1,300 a month, you are essentially living rent and mortgage free. Now, you still may have to pay some utilities, you still may have to pay for lawn care or, cut your own grass or whatever, but in general, you are living rent-free. And if you can rent it for more than that, you're making a little bit of money on the side. The key is to make sure that you look at what the area rental rates are. And for that, I use rentometer.com. It's free, it's easy to use. I'm not sponsored by them. I use that all the time for my own rentals. And you can look to see if the property that you're looking at has the potential to be rent-free for you. If you find that it's not going to work out, maybe you just cover some of the cost of your mortgage, but not all of it, or you go look for a building that either has the same amount of rental potential but has a lower purchase price, or one that has the same purchase price but is in a different area that has a higher rent potential. So I know that now you're thinking, wow, this all sounds great. What's the downside? And there are a few downsides. The biggest one is that you're going to need to learn how to be a landlord. And that means you're going to have to screen tenants, take care of issues, take phone calls, things of that nature. It's not as hard as it sounds. I've been a landlord for the past 7 years, and as long as you screen your tenants well, it is not a big deal. And I will make another video on, how to be a good landlord, how to screen tenants. It's down the road. I've only got so many hours in one day. You will have to become a landlord, and some people are and aren't set up for that mentally. Another thing is that you may have to pay for utilities. A lot of multifamily buildings in the 2 to 4 unit range are not set up with separate water, separate sewer, sometimes separate gas and electric. Although I would look for ones that have separate gas and electric at least, because those can be very volatile and very high dollar items. If you do find a building that has not separate utilities, you can still do it. You just have to try to account for that in the rental rate that you charge, and then you need to advertise that those utilities are included. So if you are charging $1,400 a month for the same apartment that across the street they're getting $1,200 a month for, if they have to pay their own utilities over here at the $1,200 a month one, and they don't over here at the $1,400 a month one, they can take that into consideration when they're looking at your place. Another con to this entire thing is that you will have to live with people. It will be like living in an apartment. However, you own the apartment. But nonetheless, you still have to live with people. You still have to share your yard with people, parking with people. It is not the same as living in a single family residence. You just have to take all that into consideration when you are looking at doing this particular scenario for your living area. But here's really the big payoff, is you only need to live in that apartment for 1 year to satisfy the FHA residency requirements for that loan. After that 1 year is up, you can then move out of that building, go get another FHA mortgage for 3.5% down, and then you can either buy another apartment building, live in that one and rent the other side, or you can go ahead and buy your single family home because you still have that first apartment building that you purchased. So now that first apartment building that was providing either all or some of the mortgage and possible utilities being covered, that unit is now still there, and you can rent out the other side for presumably the same amount of money or more if you haven't, adjusted this one's rent rate. And so now that building may be able to completely cover the next building that you buy, plus you'll be able to rent out, 1 or 2 or 3 units in that, and then now you're starting to get a profit. So you're living for free and you're making a profit. Or if you decide that you're done with apartment living and you just want to live in a single family home, that apartment building may be able to pay for your entire mortgage for your new house, depending on how expensive it is. So I hope I helped someone out there today. Leave me a comment if you have any questions about this. If you liked the video, be sure to hit the like button. Be sure to subscribe to grow your wealth, increase your success, put you on the road to financial freedom. I'm going to be pumping out some more real estate related videos from my experience in landlording, as well as the typical stock market investing videos that we've been doing, and following the major financial news that comes out. I appreciate you guys listening to me today. I appreciate you tuning in and watching. See you guys next time.